So we're going to go on, and I think the best thing to do is give a quick overview. Each person take 2 or 3 minutes, kind of give their background of why they got into their field, and then what their focus is, and then we'll go into a much more detail the next time around. So as I said at the last one, which seemed to be a hit, Marty does not subscribe to the Geneva Convention that he can only say name, rank, and serial number. But on the other hand, don't go too long into who your 4th grade teacher was or your pets or whatever right now. Let's just have 2 or 3 minutes so people get a pretty good idea what you do, and then we'll go down deeper into probably a half a dozen questions. So I see Sindhu here, the first one, who was so kind to actually have a pre-meeting this morning. So go ahead.
Thanks, Gary. Hello, everyone. It's wonderful to listen to some of the speakers and be part of this forum. So my name is Sindhu Joseph, and I'm the CEO and co-founder of CogniCor, a fintech player in the space. And CogniCor is an operational efficiency player. We are an AI-powered SaaS platform that enables financial advisors to help with their administrative operational tasks by providing a AI-powered digital assistant so that they can focus on the customer engagement and increasing their portfolio. So, if you are a financial advisor, if you ever need to fill up a form, you don't have to worry about that anymore. CogniCor is there to basically automate all of those front and middle office automation kind of tasks. So that's what we focus on. We sell to broker-dealers, wealth management firms, insurance carriers, large insurance carriers. So that's kind of the space that we are in. And we work with, a huge number of financial advisors. My own background is I've come from a technology background, so much different from many of you in this attending here. So I have a artificial intelligence background. So I have a PhD in AI. Invented several patents in machine learning and natural language processing, and have been working in the field of AI for around 20 years. And CogniCor was launched from my PhD thesis and basically expanding in the space.
Okay, that's really good. I'm going to go next to Benjamin or Ben. I'm going to go in the view of where I see people on the screen, just because that's probably easiest. So I know that I quickly looked up your bio there on Treasure Financial, and so I'd like to hear about some of your background.
Sure, Gary. Thank you, and great to be with you, everybody here today. It's my pleasure to be with you. So I'm the co-founder and chief investment officer of Treasure. And Treasure is a fintech company based out of San Francisco, and we bring the benefit of corporate treasury to SMB. What that means is that we provide a software which empower SMB to optimize their cash flow. We also help them to identify the idle cash they have in their operation, and also we provide a service for cash management for them to generate revenue from that idle cash. So essentially, what we do is we turn finance department from a cost center into a revenue generator, very much like Fortune 500 companies do with their treasury department. And aside of that, we also provide some cash management service for asset management companies, VCs, and family office. My background is in finance, so it's great to be with fellows today. Work at Morgan Stanley at the beginning of my career, and then spend the next 10 years with Peter Thiel, first on his hedge fund, and then after that in his family office. So it's great to be with other people, being a part of a family office today.
Okay, great. Now the famous Tom George is here. I think you've got a little bit different place than you had this morning. So why don't you go ahead and tell me about your business?
Yeah, I'm really happy to be here. My name is Tom George. I am the president and managing partner of Constellation Real Estate Group. Constellation Real Estate Group is a collection of residential real estate focused technology companies that service franchises, brokers, agents, and MLSs We also have a loan origination software business serving mid-market banks. So while our products cover the home buying process from the early dating phase through far into the marriage, we do have aspects in the fintech space around e-sign and transaction management and the loan production process and the loan servicing process. Constellation Real Estate Group is a subsidiary of Constellation Software, which is a 4 billion plus revenue, 30 billion market cap, publicly traded software holding company that trades on the Toronto Stock Exchange. I'm excited to talk with you today. It's a very dynamic market in residential real estate technology and prop tech. We see lots of opportunities at various stages, including the venture stage, the private equity stage, and the permanent capital stage where Constellation plays.
Okay, that's a great summary. Let me page over here. Do we have a Nick here? Nick, are you here?
Yes, I'm here.
Okay, so Nick, you didn't attend the pre-meeting there, and I wasn't on deck for the moderator previously. So this morning I madly looked up Markola, and the first thing that came up to me is that it's a Markola coffee, a counterculture cold brew coffee. So I'm just drinking this Kona coffee here. It's not counterculture, but obviously you weren't. You obviously are not the coffee guy, though I could have used it this morning. But hopefully I'll do with what I've got. So you've got actually three things. You got a Markola, you've got Type 1 and Venture YourCapital, which sounds like a whole bunch of things having to do with Family Office Hub. So why don't you give us a brief introduction to what actually you do?
Sure. Thanks very much, Gary. And thank you all very much for taking the time to listen to this panel today. So excited to be here. I don't remember my fourth grade teacher's name, but I remember the three things that I'm involved currently, and they're wearing three different hats. One is in the family office space, first and foremost, managing our family's money and making investment. The second part, I am a general partner of an emerging venture capital fund called Type 1 Ventures. And I'm also a CIO of a fintech startup. And the easiest way to describe it, it's an anti-Robin Hood platform that targets do-it-yourself investors using AI, machine learning, and NPL and so forth. We'll talk more about that. By way of background, I spent most of my career on Wall Street in the traditional banking side, worked at very large banks, Bank of America, Citigroup, and so forth, and worked at startup private banks where I headed the research departments, managed people, managed billions of dollars of assets, and then a number of years ago made the switch from that to family office space. So I said managing our families and investments, looking for very cool and interesting startups, and deploying capital through, as I mentioned, Type 1 Ventures and emerging VC fund, as well as serving as CIO of fintech startup.
Okay, great. Everybody's doing a good job. Now, do we have Elizabeth here? Are you in on this conversation?
She's not going to make it, Gary.
Okay, well, she's first on the list, and I guess I'm not going to say that's good, but I didn't check out her credentials beforehand, so maybe that makes it a little easier.
Yeah, Gary, she had to drop a scheduling issue.
Okay, that's okay. So obviously we've heard a lot about this pandemic and how things have changed both for technology and when you look at this, there's some places where I see some issues. I'm on the board of directors of a global transportation leasing company. We had massive meetings last year. We tried to do some strategic option examination, and we had board meetings going 6 to 8 hours. People just get completely whipped. But you miss the smoothing, the kind of the alignments that you can shift people's opinions on various things. And quite frankly, I've gained too much god-darn weight just sitting around there. So, and you miss the chances of going to the office, talking to people and stuff like that. So I guess the best thing to do is to say, given that we've had this change for your business and this, how do you see things change? Do you find it easier to get people? How do you vet people that are just, for all we know, they could just be a hologram, I guess. I'm not a hologram, I don't think so. But how do you get the credibility that you'd get in face-to-face meetings, or is this just something that maybe I'm sort of a generational gap? I like to actually see people in person before you do business with it. So I see Tom on the screen first. Why don't we let you take it?
In terms of the business we focus on, residential real estate, there were a number of tools in place that allowed for automation, both in terms of meeting new clients and closing deals, but the usage was very uneven. So you have a 40 to 50-year-old real estate agent who is getting to know this technology, but relying on their big personalities out in the community. All that changed 14 months ago, and they all had to quickly become experts in using technology and virtually meeting people. Not only that, seeing a house became very difficult. There have been a lot more virtual showings going on. And then as you go farther down the pipeline, the entire purchase and closing process has been something the banks have tried to automate for the last few years. There's a lot of buzz around digital mortgage, but again, everyone has had to really put their money where their mouth is and use these systems. And it's not like the Great Recession where, for instance, we have a home building software business and home building went down by 50%. So you didn't have to worry about too many sales because there weren't too many. In this case, with this great reshuffling, as the CEO of Zillow called it, people are moving all over the place. I'm sure people have left your town and come into your town. So the market is really hot. Mortgages were up 75% in 2020 over 2019. Refis doubled. So there's been a ton of activity. And that lack of the ability to do full contact selling and closing, in addition to resource constraint, has really pushed these technologies into the market in a way that I haven't seen it in the 20 years I've been in residential real estate technology.
Yeah, and that seems to be a big thing. I mean, I decided to just get a refinancing of my 2 floating rates, and I was obviously getting some good floating rates with First Republic Bank, who's well regarded here in the Bay Area, and so everything's been virtual. I feel funny. I was able to go into the Los Altos office and talk to one of the loan officers there, but he wasn't doing real estate loans, and so everything's been over the phone. It hasn't even been Zoom. And they say it's going to be 60 to 75 days closing, which seems to be a long time, although I got a fixed log, which was just fine. So yeah, so that's what you kind of miss. Okay, so we're going to come and look at your items later, but I do think it's an important a change because, as you said, and I wrote this quote down, I'm probably going to capitalize it. So it's that real estate transactions are infrequent, expensive, and complex. And so you would think that a person would want to sit down and find the person. And of course, I know a lot of big personalities in the, my community who are real estate, brokers and have changed the industry a lot. So we'll be glad to talk to you a little bit more about that. But let's go back. I think I'm going to take it in the order of the first introduction so we don't miss anybody. Sindhu, you've been in AI. And the AI thing is one where I guess maybe people are not going to even have to think anymore with all this artificial intelligence. But is there a generational gap here in terms of what you're seeing acceptance? Because we're not only looking at the general public, but we're also looking at your clients. Do they feel like they've got to kind of come and meet you in person, or are you able to sell your services in the various video conferencing since this pandemic? Or maybe you can tell me what you did before the, and how it's changed there.
So that has changed very significantly before the pandemic and after. So I have been on the flight most of the time, meeting clients face to face, and we are in the enterprise selling business, and unless we really meet multiple stakeholders in the financial services business, both from a business side as well as from a CIO's offices, we never make the sale. So that has been our experience. During the pandemic, we sold a $500,000 contract only through Zoom. I still haven't met my customer yet. So I think, that is a huge shift. And being a traditional large financial organization and financial services in specific, people are, I wouldn't say embracing this, but, there is not many alternatives. And people are willing to, deal with small businesses and fintech vendors via Zoom. So that is one change that I have seen, and I really welcome that because there is, some of the traditional sales aspects have been thrown out of the window, and you can have a much more fair playing field. In terms of the users, we are selling to large financial organizations and financial advisors. Typically, their age group is between 60 to 70 or 50 to 70 in broader terms. Although there are teen advisors emerging, but this is typically the space that we work. There is a huge resistance to adoption. And while fintech companies like ours, we try to disrupt the outcome, the best way to do that, that we have learned, is that we don't disrupt the process. So we try to embed our technology and especially AI and automation within the existing process, but not really disrupting the process itself. And there we have seen a huge amount of success.
Well, do you even communicate with letters? I mean, my wife is great for giving thank you notes. People will actually write a thank you for her thank you note because she's so good at that. We've tried our best to teach our kids, although it doesn't seem to work. And so, do you find a personal contact? Do they even use that anymore? Is everything just, texts or emails or Zooms?
It was funny. The last Christmas, we had to send basically complimentary gifts to our customers, and we couldn't find a actual firm to actually do that. So we had subscribed to an online service where, we don't have to find their home address. Usually we deliver to the enterprise office address, but in this case, we just with an email, we were able to deliver, chocolates and wine and whatnot. So, everything is going in a different dimension. Yeah.
So that's, well, before we go on to the next person, let's go back to Tom. Do you see, because I'm going to cover two questions and you covered the first one, the generational gift, the gift giving or the meetings. Do you give gifts to your customers? Does a letter show up at your office or what happens there? I think you're off on the speaker.
With our larger customers, we try to go see them as much as we can. We haven't been able to this last year. I guess software is still a face-to-face business, though we have had a reasonably productive time selling over the course of the pandemic. For our customers and their needs to stay in touch with their book of business, there are all kinds of technology, different ways to do that, but we still send a lot of postcards and fake handwritten letters, and I'm sure all of your mailboxes are full of them.
Okay, I know. Sometimes I miss the important ones. I'm just deleting like crazy. I signed up for MyPillow, and I must get 2 texts a day. I actually bought the MyPillows there to help out the cause, but what happens? Yeah, I can't get off the mailing list or the text list.
One thing I'll add is that in our smart data business, we acquired 2 companies, both focused on determining people's propensity to move. We do try to be more accurate about all that paper that gets sent. So if there's 2,000 homes in your farm, we can pick out the 400 that are most likely to sell over the next year, and that gives the other 1,600 a break on the mailbox stuffing.
Okay, great. So Ben, You know, in your business here, I'm really intrigued by your business because, you know, I moved up the financial ranks as a CFO, and I was always a pioneer for things like cross-border leases in the 1970s and 80s, where you'd get a concession on the LIBOR rate, and you did a lot of that stuff. And today I'm on the board of directors of a company that's New York Stock Exchange, and I'm always pushing the envelope in terms of let's go and try to do something like a continuous put writing program. But we end up getting a very conservative management in terms of that, and also despite the fact that Perkins Coie is like the Democratic political lawyers, and obviously very, very much on the liberal side there, in terms of their business, they're rather conservative. And so I must go in terms of trying to push the envelope on things that are completely legal, but they're things that are complete things where people don't have that in their base. So you know, you've got to have, and I'm one of the older guys on the board, although as you might expect, the most animated. So how do you attack both this generational gap, and also if you can't see him in person and get some friendliness, how do you change opinions there? And so this is for Ben. How do you change the opinions on the people?
Great question, Gary. So on our side, our sales channel has always been mostly digital, but we combine that with a very hands-on approach with our customer success team. So we like to know our customer very well. We like to know their business, and that's why we rely on this combination of digital plus a very hands-on customer success approach. What we have seen though on the COVID implication on our business is a dramatic impact on inbound inquiries from potential customer, because COVID made them realize that they need to better understand their cash flow. They need to better understand where the money is going, what is their runway, how long is their runway, what could they do to save money, and they need to get access to the tools to enable to do that, and do that in real time and with accuracy, which is always challenging for SMBs. That's on one side, and on the other side, I think, that's a big implication that we are going to see in the next like 5 to 10 years. Increase in saving rate, because people have realized that now those pandemic can happen, and there is a need of creating those cash reserve, creating those savings, so that when unexpected event happen, the company can cope with them. And then that's our approach on our side is first helping those companies understand their cash flow, helping them increase their saving, and then when they've increased their saving, helping them better manage that allocash and turn that allocash into a real asset for them and a new revenue stream. So that has been our approach, which is very precautionary and also enabling to generate a yield even in this very low environment rate.
But do they move easily? Because I've had the investment responsibilities in several long companies, and I'll give you a couple of differences. This is really dating me, but decades ago, maybe I say decades ago doesn't sound too bad, or in the 20th century, it was I guess that's not that far away. You know, Sam Zell was in charge of a company called ITEL, and he said, Gary, never invest in a AAA credit for your cash reserves, because it can only go down. You know, pretty good opportunity. So I look for credits a little lower for the idle cash. In one of the other companies I get to, it was actually a biotech that was building up a lot. They said, you know what? You always should invest in AAA credits, because you'll never lose money. And this was right after 2008. And I say, yeah, that's true, except for Fannie and Freddie and GM and Chrysler and WAMU. So, you know, there's some differences of opinion. So, you know, it seems like you would probably have an easy time selling to me, you know, and I've come up with some, you know, because I mean, I can see the risk implications, but short of having either a board member who's, done a lot of sophisticated transactions or having some guys that are able to come to the party, it does seem like it's a big barrier. So, but in terms of, do you think that you could sell better if you were face to face, or do you think that the pitch is okay? You're getting enough customers already.
Face-to-face is always interesting to get a better sense of somebody's business. But given that what we offer to our customer is software, being able to show them the software, being able to show them how our software is able to represent their cash flow, how the software is able to help them better understand the cash flow profile and help those CFO provide a better picture to those CEO. I think ultimately that's the real impact. And going back to the investment side, I think a couple of things have like there's a development of a couple of trends in the background. I think on the consumer side with companies like we've heard now, Robinhood, Braman, there's been more and more effort towards and creation of wealth, right? Like financial wellness. That's like something we're seeing. And then I think on the other side, what we're seeing with crypto and Bitcoin is concern about potential inflation. So I think there is those two big trends which I think collide and which have on our side created like a great opportunity, and we are having a lot of like interest from potential customer understanding both issues very well.
Okay, so that's a good summary. Nick, when I look at you saying that you're the anti-Robinhood, I've taken to at least scanning in the morning some of these, Wall Street bet type things, only because, sometimes they do drive the market. And so you're a family office hub, there's all this about YOLO, you only live once, and those guys, some of those guys are probably getting hosed now on Wall Street bets. I didn't check it yesterday on the Bitcoin and the swings on that, or the TINA. So in terms of selling it here, to people, do you find the personalities of the people of the family office vary a lot, or are they pretty much just trying to conserve their money? And so it's not like they're trying to push you to different things.
Yeah, I think it's very, very interesting times. And I think for us, the easiest way to understand is if we're dealing with baby boomers or so, the in-person meeting cannot be replicated, is the best way to go. I know of a scenario where someone was supposed to meet with a very, very high profile person and couldn't figure out how to turn the Zoom on and missed the meeting. So when it comes to baby boomers, you have to bank on at some point meeting them in person. You can try technology, but nothing replaces the handshake, nothing replaces the face-to-face. On the other side of the spectrum, if you're targeting millennials to Gen Zs or so, I would argue you actually are at a disadvantage if you try to meet them in person, because you may have to meet them at a Starbucks at 3 o'clock in the morning or so. So technology and doing it via Google Meets or Zoom or whatever it is, modern technology is a lot better and a lot more productive. And I read some studies that apparently baby boomers in a lifetime were expected to have 2 jobs, versus Gen Zs or millennials are expected to have over 30 jobs in their lifetime. And the difference is that, say, Gen Zs and millennials, they can find information instantaneously, pull their smartphone and get the answer. So if you don't motivate them, and if you don't provide upside and don't excite them, they just move on. They don't pay any attention to you. So if you're trying to hop on a plane, go meet them, spend half a day, flying, whatever it is, gets them for a 30-minute or 45-minute or an hour meeting, not probably the most productive use of your time when it comes to millennials to Gen Zs. As a platform, YourCapital is actually targeting do-it-yourself investors. These are folks that have capital, and they may not be big enough to be clients of very large institutions. Or on the other side, what we found out is they prefer to control their investments, and they prefer not to pay fees. And they're completely fine to do the research online. But the problem they solve is if you do Google searches and do research online, you can end up spending countless hours to get to your destination, and your destination would be a product with very high fees, or product that's maybe a pump or dump, or product that's actually pushed by questionable characters. Versus if you were to use YourCapital using machine learning, artificial intelligence in the background, and our experiences in the field, we actually curate and custom tailor solutions. So you can look at 2 or 3 solutions where you, as a do-it-yourself investor, can spend any amount of time you want on those 2 or 3 solutions, as opposed to tens of thousands of products that you can find online. So with COVID, I would argue that for us at Fintech, YourCapital, COVID has been a plus, because most of the young folks are very tech savvy, very savvy in terms of sifting through information and stuff, and getting to them was very, very easy. From our family office business, we do some real estate as well. We did our first closing, and I was going to joke and suggest that you may want to bring your bankers at First Republic, have them switch from coffee to some Red Bull, because our closing took only a couple of weeks, not 65 days or 70 days. We're concerned, because when we did the first virtual closing and we had to wire the money, we was like, gee, where are we sending this money? Is that going to go into a black hole? We'll never see it again. But it only took a few weeks, and we got comfortable after that. So we see the world changing, and COVID actually forcing this change, which for the most part, I think it's positive when it comes to technology adoption.
Yeah, so you know, I find I am the class notes secretary for my Harvard Business School class, and last year was our 50th reunion. Hopefully I don't look that old, though I might sometimes here. What happens is that there is a generational gap in terms of things, and we had a virtual reunion. We got a lot of people on Zoom. Unfortunately, for the first 15 minutes, we're blank. So everybody was talking but wasn't heard. And then we had more than 25 people on it, so we had to go invite, you know, we couldn't see them all. So yeah, but there is a generational gap in that. And so I find the difference between people that you went to school and have known for a long, long time versus going into like an RSA conference. And in some of those places, I'm 30, 40 years older than the next oldest guy. So yeah, it is a completely different context, and you do have to look in terms of how some people just don't, you know, they got to text everything, and so that is the difference. Well, that's great. That's some really good insight. So, okay, so we went through that whole round. The next question here is, in terms of opportunities, in really where you see either an entrepreneur or where you're going to fix it, where do you see opportunities beyond what's being exploited now? Again, I'm going to go back to the normal, Sindhu. Why don't we try, because AI is an area, and you know, this AI is an interesting thing that there's both pluses and minuses in terms of it. Is, you know, we hear, is AI getting so smart that eventually it will take over the world, and that you know, robots will be bossing us around, and people won't have to think anymore. I don't know what they'll do if they can't think, but do you see is there opportunities, and is there risks in terms of pressing all this stuff that people are just, you know, sitting at their computer and they're missing all the real world interactions and stuff?
Never say that to an AI scientist, like, you know, AI taking over the world, because, you know, they would be the first ones to kind of, you know, be the non-believers in that. They kind of understand where the AI technology currently. So, you know, it's for us, that's a huge, if it ever happens, that's a long, long time away. But there are, you know, multiple opportunities, you know, when it comes to financial services and AI. And as all of us can imagine, one of the, you know, key places that we should look for is automation. So especially the COVID has forced many, you know, in terms of getting the people to places, and for example, in support centers, in backend automations, in front-end engagement. So all of these places, like, you know, there has been a huge deficiency of, you know, people resources. So that's where, one of the, real focus in terms of, how do we automate certain things that either a human doesn't want to do, or can be supported by an AI system. So I think both in terms of process automation, like robotic process automation has been seen a tremendous amount of growth post-COVID, and I think it will continue to accelerate as well. In terms of customer engagement, financial services has been lagging behind quite a bit. If you want to order a coffee machine today, you just go to Amazon, within a couple of clicks, you are setting in motion an entire supply chain, and within 2 hours, you have that coffee machine in your doorstep. In financial services, if you want to change your beneficiary for your life insurance or withdraw from your 401k, you cannot imagine that kind of a efficiency. So bringing in that kind of an efficiency will become the single most differentiator for financial services to thrive. And that's where I think AI can bring in that scalable automation. How do you, in our industry, for every financial advisor that's been recruited by a broker dealer, there is 3 support agent that has been, again, recruited to support this financial advisor administrative needs. So that is a business model that doesn't scale. And that's where, AI can really provide an efficient, scalable automation that support the human decision-making. So I believe, there is a huge opportunity there, but with opportunity, there is also a huge risk as well. Because there is there is a lot of misunderstanding, information gaps in terms of what AI can do and how AI needs to be trained, and even in terms of what kind of algorithms are we using. There is a huge hype around machine learning, which is a data-driven learning model. So because it's hugely dependent on data, the performance of the algorithms will depend on what kind of data that is being fed in. So that brings in a huge amount of bias, huge amount of irregularities and compliance risk, especially in the financial services. So looking at other less explored forms of AI, which is, you can have transparent, unbiased, explainable AI that is probably more suited for financial services, but unfortunately there is less amount of investment going into those spaces. So I think financial services has to kind of sit down and rethink in terms of what kind of AI models that we should use in this highly regulated, where we are handling people's finances, one of the key aspects of all of our life. Who is building these algorithms, is there diversity in those kind of things. So all of this has to be looked at from a risk perspective. So I think there is a huge opportunity, but at the same time, I would encourage the leadership in financial service firms, to CIOs and business leaders, to kind of look into these aspects, to tailor-made AI to serve these particular sector.
But I guess there's bias in everything. And, I'm reading a book here that's #deleted, Big Tech's battle to erase the Trump movement and steal the election. But it's more important than that. It has to do with the fact that the guy talks about preparing a case study at HBS, and he said he's trying to type it up, and all of a sudden his typewriter talks back. He says, you said something politically incorrect, and you're not going to be able to type up your written analysis of cases. So he just blocked that. Well, today you're seeing that, typewriter obviously doesn't do that. Telephone, Alexander Graham Bell, his telephone, fortunately we can still use that. Fortunately, we can still use Zoom no matter what we say. Same thing for the car, the light bulbs and stuff. But in here, there's a whole group of people who believe it's politically correct to block out huge amounts of people. So I guess the further thing is, will AI be used as an instrument of control, like the social credit in China? And if so, will people just say, that's cool, because as long as I've got my, I've got all my goodies that I like in terms of my tech things, and there's no, nobody's, rioting or burning down the place, is that okay? So I guess, are we drifting toward a controlled society with AI, intentionally or unintentionally? Because there doesn't seem to be in almost anything unbiased actors. And you're probably the best person to answer that because you're involved in this so closely.
Yeah, one is like, I would put a disclaimer here. First of all, as a human society, we are already biased. So, whatever we are building, there is some kind of bias that is already built in. The problem with AI, when we are using AI, is that these biases, human biases, are getting amplified at a scale that we are not able to control and, kind of reign over. So that's where the problem is. So and perpetuate that bias. So amplify, perpetuate, scale at a scale that is at an enormous scale that we cannot imagine. So that's where I think we should look at alternative investments, alternative AI technologies that actually allow you to explain, actually allow you to find a way of looking at how the decisions are made, actually allowing at looking at data that is more unbiased. So those are the things that we should basically look at in terms of. So I'm not talking about removing the bias altogether, but just like how you would in a government or in an organization, how you would set these controls. You need to have those kinds of enablers, especially when we are building AI algorithms.
Yeah. So okay, I think I'd like to follow up after we go through another round about the TikTok and also the fact that big data can be very valuable in terms of hereditary issues and solving some health problems. But Tom, when we go to your business, I look around and you get a lot of aggregated statistics, and yet it seems to me like there's a guy there, Jeffrey Gunlock, and Jeffrey Gunlock said, there's 600 PhDs in economics at the Federal Reserve Bank, but they completely missed the entire subprime fiasco, 2006, 7, and 8. So in terms of gathering data and fintech, do you still need somebody to say this just doesn't make any sense? Or do you think that a lot of this is just data that's coming around? So maybe you could, expand on that.
Well, I mentioned earlier that we had acquired 2 data analytics businesses. One's called SmartZip, which is based up near you guys in Northern California. The other one is in Florida, called Offers. And through these businesses, we provide analytics about homeowners and their intents to move, and also what their status is in terms of their loan, and even information to get in contact with them. So there are lots of data sources about homeowners. There's lots of data sources about loans, but there was a big hole, and verifying the quality of these loans, especially around the appraisal, is certainly something over the past 10 years that has seen a lot of investment, and I think will continue to. You have a climate where I think everyone feels like asset bubbles have the potential to happen. Right now we have ultra low inventory and ultra low interest rates. People are stretching to buy these homes, and the underlying assumption is always that the most important ratio, which is the cost of the house compared to the salary of the owner, is going to hold up. But when that breaks down, and there are indications that's breaking down, I think that's when you start seeing holes in the dike and some water spraying out at the bottom.
So I got to know, as I might have mentioned to you, Dr. Housing Bubble. he's a blog people have read, and he always talks about bubbles here. But the cost of materials are going so high up. I think I caught a brief note on Bloomberg the other day that in a $300,000 house, and that's obviously someplace not around here, that the lumber cost was like $36,000 or something. But lumber's gone up by a multiple several times. So there's an issue here, and it has, notwithstanding the fact that copper and other things have gone down, for the cyclicals have gone down for a couple of days. There's something called an energy transmission that the International Energy Commission talked about in the Wall Street Journal a couple of weeks ago, and that is that the light footprint that you have with oil, you know, and it can be transmitted by pipelines or tankers or whatever, is going to be replaced by some really heavy footprints, in that the electric cars cost so much more in terms of materials like copper, and to build a plant, or the rare earths for the different products that are really heavy, grind up massive amounts of rock and chemical processes. And so what's going to happen then is that you're going to have a tremendous energy consumption to build these things. And so there's going to be huge cost increases on everything. You know, and you know, the whole we're getting all, you know, the cheap panels from China, polysilicon, they got like 90% of it. They've got all the rare earths. And so will it be that the cost of housing just gets so high that the only way to solve it is really to cut out the regulations and let people build without these massive, you know, amounts of reviews and stuff? The guy's building, a Facebook guy across the street, it's actually a pretty nice guy, building a 10,000 square foot house across the street, although some of it's underground. And it took him 2 years to get his goddamn building permit. It's taking 2 years to build. So is that, can technology help that out somehow? Or are we confined to kind of local, what I call little Napoleons who are on the planning commission, who, you know, want to micromanage every little thing? I mean, will technology help both? And I just got a note from Marty. Will it help in terms of green, in terms of just less time, less waste? Will it help in terms of just, you know, bringing a better, lower cost house to a person? Can you help in those ways?
Great. So actually, I need to clarify the question. I'm not talking about making things ESG compliant. I'm talking about greater fields that are available in venture capital or investing that nobody's actually playing in right now. And, you know, there's lots of examples in emerging markets. So it's like the old saying about cell phone usage in emerging markets, right? Everybody anticipated there wouldn't be a lot of cell phone usage because they thought that you had to go through this generational cycle of building out a telephone network, and then people would get used to using a telephone, and then they would go and then migrate over to mobile phones. But actually, that's not what happened in the emerging markets. People just went straight to mobile phones. You never had to do that middle step. Is there such a thing happening in fintech right now?
Okay, so okay, with that clarification, I guess the biggest thing is you do save some paper, I guess, in terms of the fact that you don't have to, a lot of application type things are become digital, and so all the paper that wasn't spent can be used to make cardboard straws, so you can, you know, suck on your drink with a cardboard straw instead of plastic. So maybe that's the green thing. Why don't you go ahead and elaborate on that, Tom?
Yeah, well, sure. There were a couple of questions in there, and I'll try to address a couple of them. So a sister division of mine is the biggest provider of software for the home building industry in North America. And so most of the major home builders are customers of ours, and we're hearing all the time what's going on with them. They've never reached the pre-Great Recession start peak, which was about 1.8 million homes a year. And they became very conservative because they all got their shorts handed to them when they were very long on land in 2009, 2010. And the businesses are doing well, but they have continued to under build relative to demand across North America. And some of that is, especially in places like California, constrained by local regulation. But there's also a broader theme where they have just been overly conservative, for over a decade. Now, this year, I think they're going to get to maybe 1.2 million starts. So it's still well below where they were historically. So I know it's not necessarily fintech, but there is a fairly long-term missing supply in the new home segment, and I think there's an opportunity there for sure. In terms of the inputs, actually, there's a similar story specifically around lumber, and some of you may have read about this recently. But there's plenty of trees in Canada and in southeastern U.S., but there aren't a lot of sawmills. And the same thing happened. The sawmills got crushed in 2009, 2010. They never got back to the capacity they had before. And all of a sudden, we have this fairly short-term spike in demand. And it's not necessarily economical to start setting up a sawmill now, have it going in 2 years, and then the demand's gone. So it's these interesting kind of historical supply constraints that seem based more on history than, the fact that there's a market for them. And, investing in home building, I think would be an interesting area to consider.
Yeah, in fact, they say that growing trees is a non-correlated investment that always goes up in terms of if you're in your 20s or 30s or 40s, you should, go buy a tree farm or whatever. I think Weyerhaeuser split into offering, big lots for that. So that's a good thing. Yeah. So, okay. So that's good. We're going to get around on everybody. Ben, maybe you can take off from that. You're really, I guess the biggest thing is digital relationships. My son was, filling out his tax return, our younger son, and I says, why don't you print your financial statement so you have it there? He says, no, I know it's online. He doesn't have it. Whereas I've got my whole house stuffed with records that are, I probably should get rid of, but I'm not. So what can you help from the green kind of point of view, but also in terms of this, do you see some dangers in too much stuff being online, that it can be hacked, or is there problems there? What do you see there?
Yeah, I mean, to respond to one of the questions asked on the chat by Ashkan about open banking and transaction data, I think that's a huge opportunity for fintech. I call it the data emancipation, which is basically enabling customer to get access to their own data and benefit from their own data. And at Treasure, that's something that we truly believe in. So there's like two steps in that process. First, accessing the data, and then empowering people with that data. And basically, it's putting back the customer at the center, and not like away from it. And that's very much what we do on our side. We basically help customer make better sense of their transaction data, of their financial data, to optimize their finances. And I think the direction which is taking open banking is very much enabling that, and it's moving away from, like, I would say, like the traditional banking system, or like traditional banks, or like legacy banks, which actually don't put the customer at the center. The only thing they care about is getting hold of the deposit in order to speculate on it and make loans. They don't really very much care much about their customer. And like a question I would have for everybody is like, what has your banker done to you lately? Like, when was the last time you talked to him? When was the last time your banker helped your finances directly? And I think that's a huge trend we're going to be seeing in multiple different sectors. Is first getting access to like the amount of data that each customer sit on, and then the next step, which is even more important, is enabling them to benefit from their own data. That is very different than I would say a lot of tech companies are being built at the moment. For example, companies like Google or Facebook, they actually monetize the data for that they have on their customer. My view of the world and how things going to shape out is basically getting the customer back access to their own data and directly benefiting from their own data, and basically having much more of like an alignment between fintech companies or like tech companies and their customer. I think there is a big trend emerging in that direction. I'm very hopeful to see the benefit of it.
So in my earlier days, 20 years ago, I worked for a broker dealer. I actually was the CFO, but I got all my FINRA licenses. Actually, at that time, it was NASD. And so one of the things you found is that there was a lot of guys that would churn and burn people. The guy would, and the founder said, a contact is a name or a phone number. A name and a phone number. Hopefully not written on a wall in the bathroom, but that was all he wanted, and he could try to sell them the product of the day. So is it dangerous in terms of it that people, and I would get people like that trying to sell me some 10% loaded partnership or whatever, because that's what they've got a sales contest on. So is all this data, the fact that they know so much about the customers, the buying habit, is that good for the customer or just good for the financial advisor?
I think that's good for the customer if the partner that you're choosing is not selling your data to somebody else. I think that's basically depending on what partner you choose, and if that partner, the company that you're using, has your own interest in mind or not. At Treasure, like what we have decided to do is basically use the data of our customer to their own benefit and not share it with anybody else. I think very few people tend to do that, but for us, what we care about is a win-win relationship with our customer and a very clear alignment with them, so that if they're experiencing an increasing in their financial operation, we benefit from that the same way they would do.
Okay, so believe it or not, I see Eric Singer coming in here. I was trying to see if he was subbing out for somebody, but he is going to have a presentation on hard tumor treatment, which maybe one day will be of interest to all of us, but hopefully not. But before we go, though, because this thing seemed to go faster than we thought, I think I'd like to get a 1-minute wrap up or so on each of you, because Sindhu, could you go ahead and give a 1-minute wrap up here, given the fact that time flew quicker than we thought here?
Turn on your mic.
Yeah, sorry about that. I think, from my perspective, there is one of the questions was whether fintech was still a hype. I think there is a huge opportunities in fintech, especially in direct to consumer markets and in operational efficiency, and as well as in cloud, which we did not talk much about. So I think there is a huge opportunity, and we should be all, especially having an AI background. I believe it's going to play a crucial role in defining how things are going to shape up. So that's my big take from this.
Okay, Tom.
One topic we didn't get a chance to talk about is crypto technologies. And we've been researching this a lot lately. We see opportunities in verifying home data, things like valuations and rent rolls, collateralizing the home, and NFTs that show ownership of the home. We recently entered into a partnership with a company called Chainlink to provide that first kind of data, AVM, things like that, that can be shown to be bona fide. So that's an interesting area as well. You may have seen that the SoFi founder raised $200 million recently to get to a $3.2 billion valuation for a blockchain-based lender that does mortgages and refis. So this will inevitably certainly enter into the home transaction and other parts of fintech as well.
Okay, Ben, any final thoughts?
Yeah, I mean, on my side, I very much think that we're seeing a fintech renaissance, which is driven by technology, cloud computing, and the rise of AI is enabling provider to basically increase the financial wellness of their customer, providing much more customized solution to that, solution in real time. And at Treasure, we are happy to be providing that to SMB, which are around like 60% of the employment in the United States and are in dire need of getting better use of their finances and a stronger hold on what they're doing. So I'm very happy to be contributing to that.
Okay, Nick, we didn't let you answer the last question, so maybe I give you a minute and a half here to summarize your thoughts.
Thank you. I'll just be very, very brief. I think fintech is here to stay. We're in the very early stages of the whole thing. I think in the years to come, we'll probably see some of the large companies today not be as large and not be as dominant, and have new companies who may not be in existence today or maybe very small be the dominant players down the road. So it's not a question of if, it's a question of when we see this rotation, and obviously very excited about fintech. One of the questions I believe somebody asked earlier, what are the green fields or the opportunities? We see them in the do-it-yourself space. Global population is 7.8 billion currently. It's going to about 10 billion. And in the US, we have about 330 million people. Of that, about 100 million have investments in publicly traded securities, but there's a large number of folks outside the US who would like to get in as well. So the opportunity to do-it-yourself space, I feel it's enormous. We'll argue that servicing large financial companies is probably a good fintech opportunity, but we're more excited about do-it-yourself space, which is a lot larger space, a lot greater. As a family, we invest our own capital. I'll put my contact details below, not to take time from Eric. So to the extent you're a founder or so, as a GP of a VC fund, you have capital to deploy, we'd love to hear from you. To the extent you're a startup or so, please reach out. So thank you very much for taking the time.
Okay, great. You know, I tell you, this topic, we could have gone on for another hour. And maybe next time we will have a little longer space. It is a fascinating space. So thanks for everybody. I really learned a lot, enjoyed this conversation. And I guess, Eric, you're going to have a short introduction from Marty. So I'll turn it back to